Hi, this is Dr. Tahir. In this video, I will be presenting to you some of the basics related to common stocks. If you wanted to reference this presentation, these slides are from chapters 6 and 7 of our text. The biggest appeal of common stocks is that you become an owner in the company when you own common stocks. And this ownership is called residual ownership. And you can maintain that proportionate ownership in that company. So, for example, if you buy 1 share of Apple, then you have 1 divided by all the shares outstanding. The answer to that equation is your ownership in Apple. Yes, this is a very small ownership. If you put a decimal, a point, then start putting zeros and put a lot of zeros and then 1 and a percentage, that is your percentage ownership in Apple. But nonetheless, this is ownership. So common stocks is a great way to own great companies. Now, common stocks could go up and down. There are many different industries within the economy, like housing, like consumer discretionaries, like transportation, and they all have their own industry cycles, and the economy has a cycle of its own, and that's called the business cycle. So the business cycle has its peaks and has its troughs. So if you take a look at this graph, something that I wanted to show you is this. Look at this red line. And we're going to talk about it in the upcoming presentations as well. But you see this around May of 2009 timeframe. That is the stock market, the S&P 500, formed a historic pattern, and this is one of the biggest capitulations that we have seen. And this pattern is called capitulation. And when capitulation happens, the market is a falling knife, and it just overdoes it on the downside. So you see around March of 2009, the market hit its bottom. And if you see this type of a chart pattern again, this is your buying opportunity. This is the time to buy really great companies at bargain basement prices. So we had one capitulation in March of 2009. And at that time, there were amazing buying opportunities in the market. If you had bought some really great companies at that point, you would have had 1,000% return by 2016. So what I'm trying to say is that if you see an opportunity like this, this is your time to buy great companies. And we're going to talk about great companies and how to identify them in this presentation and in my next presentation. The stock returns, historically, if you average them from 1900s, they are 8 to 10%. You invest money in the stock market if you do not need that money for the next 10 years. So there has to be 5 to 10 year time horizon, 5-year minimum, in order to make healthy investments that are going to give you healthy returns. Stocks give you returns in 2 different ways. You can earn dividends, and the dividends are the portions of the earnings that the companies distribute, and capital gains. And capital gains are the difference between your buy price and your sale price of a security. So if you invest for more than 5 years, ideally for 10 years, it's highly likely that you're going to have a positive return. Unless you invest right at the top of a bubble where the markets are really not properly valued. So valuations is the key. So if you invested in 1999, that was a top of the bubble, and it would take a long time for you to even get to that point again once the market tanks. The great buying opportunities happen either at capitulations or near capitulations, and in terms of business cycles, they happen at the troughs. And some of the most successful investors are value investors. One of them I would highlight here, his name is Warren Buffett. Warren Buffett started his investments from a very young age, and he invested in great companies like Coca Cola um, and Geico Insurance. And he basically, his philosophy is that you have to go by the valuation. You buy the company when it's nobody wants it, and you are the first one to pick it up, and you buy it at a great price, and then hold it for a long term. So we're going to talk more about that later in this presentation and in my next presentation related to common stocks. In terms of the bear market, you have a routine decline, which is about 5% drop. Then you have the correction territory, which is a 10% drop. And then you have a bear market. And the bear market is the buying opportunity. This is when the stocks go on sale. And this is when you pick up really great companies at great price. For example, Apple Computers in March of 2009, on a split adjusted basis, was trading at $15. So if you don't do the split adjust, let me just do without the split adjusted basis. Without the split adjusted basis, March of 2009, Apple Computer was trading at $68. And then it went on to become a $700 stock before it split. And we would talk about stock splits later on, but that was the best time to buy companies like GE, companies like Apple Computers, companies like Coca-Cola, Disney, really great franchises at bargain basement prices. So the bear markets are really, really good buying opportunities for smart investors. Some of the advantages of ownership of stocks, they serve as a hedge against inflation. All real assets, whether it's gold, stocks, or real estate, they serve as a hedge against inflation, meaning that in the face of inflation, they protect their price levels. Their stocks are easy to buy and sell. Price information is easily available, and now with this online brokerage accounts, it's very easy to buy and sell stocks. Some of the disadvantages are the risks associated with the stocks. There is a business risk, which is that the business could go down. There's a financial risk, um, purchasing power risk, market risk, and event risk. So yes, there are risks related to ownership, but one of the biggest principles of investments and finance is that the higher the risk, the higher the potential return. Not the actual return, but the potential return. So yes, your risk taking gives you great opportunities. So, in March of 2009, buying Apple computers on a split adjusted basis, less than $15 per share. Apple now on a split adjusted basis is trading at $106. So you took a risk if you bought that stock in March of 2009 because it seems like the world was ending and the market was going to go down to zero. But if you really held your nose and jumped in and bought some really good quality names, you would be up 7 times, 10 times the prices that you would see from March 2009. Some of the basic characteristics, some terminology related to the common stocks. The common stocks are referred to as equity capital. They are equity capital because you get ownership in the company. Common stocks are referred to as publicly traded issues, means that anybody who wants to buy them can buy them. And then when they're offered initially, they're called a public offering. Then you have the rights offering, which is offering of the new issues. When the new issues are thrown into the market, the existing owner, who are the residual owners, can maintain their proportionate ownership of the stocks. So, for example, if you own 10% of Apple computers, if Apple throws in 100 more shares, you have the right to buy 10 of them so that you can maintain your ownership. Spin-off. Yahoo is in the process of spinning off a part of their business. One of the most famous spin-offs is Kraft Cheese, which was part of Philip Morris, the tobacco company, and they, in order to diversify their risk, they owned Kraft Cheese. And then about 10 years ago, they spun it off, and Kraft became a name of its own. Stock split. Companies like to keep the stock price, which price is not the price. The real price of the stock is the valuation of the stock. Price is just a number. And companies pick that number. So, for example, Microsoft likes to keep it below $50. Apple Computers likes to keep it around $100. When they went to $740, they split the stock. So for every one old shares that you had at $700, for example, now you would get 7 new shares at $100 each. The value of the stock stays the same. It's just that the price is now more manageable for the new investors. So the lower price brings everybody in, and some stocks are very, very highly priced to deter too much trading, buying and selling. For example, Berkshire Hathaway's, which is a company run by Warren Buffett, one of the most successful investors in the history of investing. His company, Berkshire Hathaway's Class A shares, are $122,000 per share. And ever since he started the company, the shares were probably less than $1,000 at that point, many, many years ago, and then kept growing, and he never did the stock split. So now if you wanted to own Berkshire Hathaway's Class A, in order to get just one share, you need to come up with $122,000. Treasury stocks, these are the shares that were originally sold and then repurchased. And the reason to have treasury stocks is to keep less shares outside. Do the buyback program if you feel that your stock is undervalued by the market. And this is also used for employee stock options and for M&A. Now let's take a look at a stock quote. This is one of the brands that I like a lot. The first thing that you see, Yahoo Finance is a great place to look at stock information, and this is coming from Yahoo Finance. You see the name of the company, Abercrombie and Fitch. ANF is the ticker symbol, so this is the unique identifier for the company. 35 is the price of the company at that particular point. It seems like it was after 4 p.m. when the market closes. Market runs from 9:30 in the morning to 4 o'clock. The previous day, it closed at $36.38. It opened that day from where the stock quote is taken at $36.35. Last, there were people bidding, or they were offering money to buy this Abercrombie shares at $35.40. But those who were selling, they were asking $35.72. So bid is what you're willing to pay for it, and ask is what you're willing to sell it for. And then somewhere in between bid and ask, there is a settlement, and that becomes the last price. For that day, the stock ranged between $35.48 to $36.42. Beta is the measure of risk. It shows how volatile the stock is. 1 is the average market beta, and less than 1 means that less than average market volatility, and more than 1 means more than average market volatility. So this is twice as volatile as the market because the beta is 2.19. For that particular week, 52 weeks, 1 year, the range of this stock is between $28.64 to $77.49. Next, the volume is 2.3 million shares traded. On an average, is 3.4 million, so the trading was a little light that day. Market cap shows you how big the company is. Market cap is calculated by multiplying the number of shares in the hands of investors times the price of the stock. So a $2.94 billion company would be considered a mid-cap company. Now the next number is the, if there is a price of this stock, the next number is it, and that's price to earning ratio. The average market price to earning ratio right now in S&P 500 is about 16 times earnings. But this stock is trading at 34 times earnings. Now, that is okay if it's growing more than 34% year over year, but if it's not growing by that much, then this stock is expensive. So you want to look at the stocks that have PEs of less than 17 or 18 times earnings. Some more terminology. Round lot means that you buy 100 shares, but if the stock is very, very expensive, even 1 share could be round lot, like Berkshire Hathaway's Class A shares. Odd lot is if you have less than 100 shares for stocks that are not high in price. Then we have the par value, book value. These are useless numbers. They don't mean anything. They've been just part of the terminology since the early days of stocks. Now, market value is the current price of the stock. Market cap, we talked about it. That is the current size of the company, and you calculate it by multiplying the total number of shares outstanding by the market price at a given point. You gain in stocks by 2 different ways. You can earn dividends, which is a quarterly check 4 times a year, and capital gains. And capital gains is the difference between what you bought the stock at and what you sold it at. The difference between the two, if it's a positive difference, then it's capital gains. So in March of 2009, if you bought Apple at $15 and then you sold it for $100, then the difference, $85 per share, is capital gains. So if you bought 1,000 shares, then that's $85,000 in capital gains. And Apple, of course, did not pay any dividends. Most of the growth companies don't pay dividends. They just reinvest the earnings into the company. If you invest in a dividend paying stocks, then there are 4 dates that are to look for: declaration date, date of record, ex-dividend date, and payment date. Earnings per share is a very, very important number because it gives you your price to earning ratio. So in order to get price to earning ratios, you need to calculate earnings per share. And earnings per share is net profit after all taxes minus all the dividends to the preferred stocks. So that gives you the earnings after you clear taxes and dividends. So it's earnings divided by number of shares. So if you earned $100 and then you had 10 shares, that means that it's $10 per share that everybody's going to get. So 10 owners, and the company earned $100. So if you divide it into 10 owners, each one gets $10. Dividend yield is a very important concept. It tells you what percentage of dividend return you provided to your stockholders. The You look at the annual dividends per share divided by the market price. Dividend payout ratio, of course, all the earnings that the company earns, they don't pay it all in dividends. So let's say if the company earns $10 per share and the dividend they gave was $1. So $1 divided by 10 is 0.10 or 10% dividend payout ratio. Means that out of all the earnings, 10% of the earnings they paid out in dividends. The stocks can be of many different types. There can be income stocks, and income stocks usually pay dividends. So what you're looking for is constant income coming in. Usually all the utility companies like Pico, Verizon, they are income stocks because they pay very high dividend. So out of every dollar they earn, they 85 to 90% they pay out in dividends. So your goal is not to gain in terms of capital gains, but to receive a quarterly dividend check that you can use as income. Stocks usually don't pay dividends, but they reinvest their earnings into the business and grow more and more and more, and the stock price goes up as a result of the price to earning multiples becoming sweeter and sweeter, and therefore you make money through capital gains. And again, capital gains are the gains from the price appreciation in a stock. Speculative stocks, they don't have any good valuations, they don't have good cash on the balance sheet. The balance sheet is not good. Price to earning multiple is very, very expensive. But there is some catalyst happening that could take that stock way, way up. For example, in the days of Blockbuster slowly fading away and Netflix gaining popularity, the Netflix stock probably was a speculative stock because they were investing a lot of money into the business, but it was a good investment if you could pick up the mega trend. And the mega trend was that streaming was the way to go. Cyclical stocks, they go up and down with seasonalities. Defensive stocks, they remain stable and they are like solid names, things that people would not give up even if the economy goes down. So, for example, Walmart, Coca Cola, the dollar store, some of the utility companies, you have to keep the electricity. All of these are defensive names. Means that your investment is not going to go down too much, but it doesn't go up too much either. So the lower the risk, the lower the potential return. Market cap. We talked about market cap. It is if you multiply your stock price with number of shares outstanding, you get the size of the company. Small companies are considered those companies that are less than 2 billion in market cap. 2 to 10 is mid cap, and more than 10 gives you large cap. Investment strategies, you can buy and hold, which is the best strategy. But when you buy it at a sale price. And the sale price happens in the correction and in the bear markets when the market is down. That is your buying opportunity. And then you hold that stock for a long term to make the price go up and therefore getting some capital gains. And if it's a dividend paying stock, you can get dividend as well. Current income, these are the stocks that pay now in the form of dividends. Long-term growth, and these are the stocks that are on a constant growth path. So, for example, we've seen that with the likes of Google, Apple, Facebook. They've been growing constantly over many years. The stock management, you have to involve risk strategies. You have to decide what's your primary goal, and you have to decide when to get in. The entering into the market and buying the stock at the right time is the key to making good potential returns. Speculative short-term trading is highly stressful, and nobody has the ability to know to do the market timing. So usually, especially small investors, lose a lot of money in speculative trading. If you do speculative trading, it should be for less than 5% of your portfolio. In the security analysis, we gather information first related to economy, related to the industry where the security is from, and the security itself. The real price of a security is not the price. Price is an arbitrary number. Berkshire Hathaway's Class A shares at $122,000 are more expensive than Apple computers at $100, because the real price is in the value. So this is a three-step process for doing the security analysis. First, you do economic analysis, then you do industry analysis, and then you do the company analysis, looking at the financials and ratios of the company itself. The efficient market hypothesis is a very important hypothesis in investments. Means that when information comes out, the investors get that information and act accordingly. Fundamental analysis, you look into the security itself and look at the three kinds of ratios: profitability ratios, liquidity ratios, and asset and management performance ratios, to see how much value there is in the stock. Some of the economic measures that are helpful: retail sales, it tells you consumer attitude; money supply tells you the situation of the inflation, and so does the CPI. Employment numbers tell you business production. Housing starts gives you the cost of money. So different economic indicators give you different indications for the investments world. The financials are very important to look at before you buy a company. You look at the balance sheet to see what they owe and what they own, and what's the situation of the equity. The income statement is very important. It shows you top line, which is revenues; bottom line, which is profit and loss, and all the expenses in between. So top line is the top line because that's the first number that they report on the income statement, and that's revenue or sales. And the bottom line is the last number, which is the profit or loss. Cash flow statement is important because it shows you the sources of cash and also the uses of cash. The companies are required, all the public companies, the companies that trade in the stock market, they're required to have 10K, 10Q statements, and these statements are provided readily available to any investor. So you can request all the numbers, all the financials about any public company, and you can get them online. But this day and age, Yahoo Finance has made the job really easy. You can take a look at any public company's financials on Yahoo Finance, and they calculate your ratios as well. So you can see some of the key ratios under key statistics on Yahoo Finance. Financial ratios, very important, tells you the financial health of the company. It is the lab report. Many different types of ratios. Liquidity ratios tells you how are the company finances in terms of meeting their debt obligations. Activity ratios show how the company is managing their resources, their assets. Leverage ratios tells you the amount used of debt and how effectively did the company use it. Profitability ratios, of course, show you profit. So all these ratios are very important, and understanding some of the key ratios is very important task for anybody doing security analysis. So let's take a look at some key ratios and what they mean. Current ratio shows you your current assets, means the assets that are liquid or near liquid, and current liabilities. These are the liabilities that are less than 1 year in maturity. You must pay them before the calendar year is over. So the higher the ratio, the more liquidity you have, and the lower the ratio, you have less liquidity. So when you're looking at current ratio of a company, you're looking for a higher number. In capital shows you how much capital you have at hand to meet your daily obligations, and you subtract current liabilities from current assets to get this number. This number again also is higher the better. Accounts receivable turnover shows you the performance of the management. This is a management performance ratio. You take a look at your sales divided by the receivables, and it tells you how good you are handling your receivables. Asset turnover, total sales divided by total assets. The higher the number, the better it is. Debt to equity ratios, it shows you the total long-term debt divided by the stockholders' equity. The lower number is better in this case. Net profit margin, very, very important profitability ratio. It shows you how many pennies on a dollar do you earn. So 26% profit margin could be nice. Many good companies with a lot of differentiations and good products make a higher percentage in terms of the profit margin. The higher, the better. Return on assets. You divide your net profits by the total assets, and this ratio is also higher, the better. Price to equity ratio, PE ratio, is the most important ratio in security analysis. You take a look at your earnings per share and you divide your earnings per share with the stock price. And this multiple right now in S&P 500, which is 500 biggest companies in the US, the average PE is around 16 times earnings. So if a security is more than 16 times earnings, it has to justify itself by the growth rate. You can tolerate higher PEs for higher growth rates. Growth in either the top line, which is revenues, or the bottom line, which is earnings. If, for example, some companies trading at 40 times earnings, but they're growing their top line and their bottom line by more than 60%, then it's justified that you own that company because their growth rate is higher than their price to earning multiple. So this is an example. So this company, $139 million in total earnings, and 61 million shares were outstanding. So each share would get $2.26 in earnings. That's EPS. The company is trading at $41.50. If we divide that by the EPS, we get 18 times earnings. Now, looking at this, it is a little bit expensive unless the growth rate for their top line or their bottom line, meaning their revenue or their income, is higher than the PE, then it's justified. Price to earnings to growth gives you that number, that one number that shows you how is earnings as compared to the growth. So it takes the PE ratio and it divides it by the earnings growth in 3 to 5 years. If it's greater than 1, the company is not that much of a value in terms of growth. If it's equal to 1, that's good. But if it's under less than 1, then it's really good company in terms of the growth. Dividend payout ratio shows how much of the dividend earnings was paid out in dividend. So looking at the financial ratios is very, very important in doing intrinsic value analysis for a security. We covered a lot of terminology here, many different ratios. The bottom line is when you buy securities, you must do research. The price of the security doesn't mean anything. It's the valuation that matters. And in terms of valuation, you'd look at 3 different types of ratios. Liquidity ratios to see how company can meet its debt obligations. asset management ratios to see how company is efficient, how management is running the business, and profitability ratios show you how profitable the company is. So the intrinsic value is the real price of the security. We will talk more about it in our next video, where we will talk comprehensively about stock valuation. And in that video, I'll show you how to value stocks. And that's next week. So until then, I wish you the best of luck with the quiz. I want you to read these two chapters, 6 and 7, comprehensively. Take your notes before you take the quiz. And I look forward to your contributions in the discussion forums. And I look forward to reading your amazing, amazing assignments.